All right, Carrie, looking at the time, I guess we can go ahead and get started.
Hello, everyone. Thank you all for joining us today. I'm Carrie Tomei, the Managing Director with NVNG Investment Advisors. The topic today is venture capital throughout the Midwest. Venture capital investment continues to spread from Silicon Valley to the rest of the country. But as we know, the West Coast still dominates the market by a pretty wide margin. Venture capital can play a crucial role in building fast-growing tech-based economies like those found in the Bay Area, Seattle, Austin, New York, Phoenix, Boston. But many venture investors still prefer to remain close to portfolio companies and typically don't stray too far outside those markets when looking for the next big thing. Further, as we all know, the majority of U.S. venture capital funding is still sent to California, New York, and Massachusetts. Even so, today we are seeing investors with Silicon Valley roots branching out and raising funds in new location where they see untapped potential. Investors both inside and outside the usual tech epicenters seem to agree that even with the very real progress occurring in these regions, it'll take an increasing number of successful exits and the engagement of more local institutional investors to achieve that next level of success. Roy Bahat of Bloomberg Beta perhaps said it best when he stated that the days of VC hiding in a bunker in Silicon Valley are coming to an end. If we want to realize the full potential of technology, we need people everywhere making it. And in looking everywhere, we believe the Midwest has the right innovation ingredients to become the home to the next wave of startup investments. So let's just look at some of the stats. The Midwest, for example, is home to 1/3 of the Fortune 500 companies and more than 20 of the nation's largest research institutions. And we're fortunate to sit next to them, right next to one of them here in Madison. It accounts for 26% of the nation's corporate and university patents, and it includes 31% of U.S. university-based research and development, including 34% of highly competitive NIH research funding, which is key to creating new drugs and medical technologies. 35% of the total bachelor degrees holders come from the region, as well as 33% of STEM grads. The Midwest accounts for 32% of all higher education degrees awarded in the United States. The assets are in place, but the Midwest still falls behind in venture funds and the ability to easily attract the capital to commercialize that innovation and thereby fully deliver on the very real results we touched on earlier. Putting all of that together, and fortunate for those of us who live here in the Midwest, as illustrated, we do possess many of the ingredients and a growing amount of venture capital needed to capitalize on the startup opportunities that arise out of this once labeled flyover country. Today, we're going to discuss with a few of our VC friends why they chose to be here, what startups they're finding, how things have evolved to date, and what they believe the future holds. At NVNG, we aim to build bridges that connect investors to the innovation occurring in their backyards in our efforts to grow the Midwest entrepreneurial communities. And because we live and operate here, we're working hard to raise Wisconsin's reputation across the venture capital industry. We're proud to be a female-led firm, and while our panel today reflects the quality of the growing Midwestern venture capital ecosystem, it also represents the work we all need to be doing to ensure diversity grows beyond just cognitive diversity. During the panel, we will explore the question of diversity and how our panelists approach it in their firms and portfolios. A new awareness has definitely taken hold, and there's no going back. NVNG is happy to be a new entrant in the ecosystem, and we're committed to doing our part. We're led by a team of 3 individuals, Grady Buchanan, who will be moderating today's panel, Linda Likeness, and myself. And with that, I am going to turn it over to Grady so we can start the discussion. Thank you.
Thank you so much, Carrie. And yes, this is obviously a topic that I'm very excited to cover. Our team's very excited to cover, and it's one of my favorites, to be honest, as it is with these guys. So with me, I have 4 individuals, each representing their own venture capital firms, and I just want to introduce them as individuals first and foremost. So starting with Victor Gutman. Victor is the founder and managing partner of M25. Victor grew up in Northwestern Indiana before moving to Chicago to study economics at the University of Chicago. Victor has a passionate history with startups, including a vending machine business, as well as a kick scooter company, along with being on the board of the University of Chicago's first student-run venture fund. He's also a Kaufman Fellow and a former leader in Hyde Park Angels, which is still an active group in Chicago today. He founded M25 in 2015 and quickly grew it to become one of the most active venture funds in the region. Victor, thanks for being here. Joe Biller, Managing Director. He joined 3x5 Partners in 2019. Prior to 3x5, Joe was the Managing Director at Sightline Partners, where he helped raise over $250 million to complete transactions in the healthcare sector with a big focus on medical devices. And during his 14 years at Sightline, he served on numerous boards and has led or was actively involved in completing transactions in over 50 companies. While at Sightline, Joe did invest right alongside his current firm, 3x5 Partners, for over a decade before deciding to join them full time. While up in Minnesota currently, Joe is a native Wisconsinite, as you can see by his polo, and he grew up not too far from our own NVNG offices just here in Madison. Evan Ufer, partner at Plymouth Growth Partners. He focuses on sourcing and executing lead investments in technology-based businesses. Since joining in 2014, he's led 6 of Plymouth's investments and has been involved in many other successful financings. Prior to Plymouth, Evan served as the VP at Quilvest, which is a private equity firm over in New York. He focused on evaluating and executing direct private equity investments, buyouts, recapitalizations, and growth equity in industries such as software, telecommunications, and manufacturing. Evan actually started his career as an architect at the Smith Group, one of the oldest and largest architecture and engineering firms in the US. And Evan's based in Ann Arbor. And Natty Zola is a partner at Matchstick Ventures, an early stage VC fund focused on investments in leading technology companies throughout the middle of the US. Prior to, Natty was a managing director for Techstars' flagship program over in Boulder. Natty has also been a founder at a venture-backed company and led it through a successful exit to AOL. He's also led consumer products for MapQuest and helped research and contribute to best-selling books such as Great by Choice and How the Mighty Have Fallen by Jim Collins. He's also passionate about helping entrepreneurs figure out their product market fit, build culture, and make the change that they want to see in the world. And Natty comes to us from Boulder, Colorado. So guys, thanks so much for being here. I'd really like to start by letting each of you talk a bit about your firms and your respective strategies. And for those unfamiliar on our webinar today, give us the quick elevator pitch. Victor, I want to start with you guys in M25.
Yeah, thanks for having me and thanks for putting this awesome panel together. M25, we are by many definitions, the most active early stage VC firm in the Midwest region, which for us that stretches from Minneapolis to Kansas City to Pittsburgh. We are a generalist firm, meaning that we invest in most things technology and digital centric, so software as a service, e-commerce, digital marketplaces, tech-enabled services, even some hardware IoT stuff. We don't do as much life sciences or deep tech, and we are generally among the earliest stage of investors that you'll find out there. So some of the times the companies are pre-revenue at the product stage. Most of the time the companies are somewhere between $5,000 to $50,000 a month of revenue, almost always less than $1 million in revenue. So just to, for a little bit of context, the funding rounds typically look like $500,000 to $3 million that we would participate in, and generally less than a $10 million post money is what we're the stage that we're in. So, sometimes that would be called the first institutional round, and the name feels like it's constantly changing, but we call it pre-seed or seed, depending on kind of the size of the raise. I'm one of 2 partners at M25. We're based in Chicago. We have 5 full-time people. We have an office in Indianapolis as well. We've made 2 investments in Wisconsin to date. One, Scanalytics in Milwaukee, and the other, Enzo Data in Madison. Excited what we're seeing in the state, of course, and yeah, I think I'll probably leave it at that, but excited to be on here.
Perfect. And Joe, let's go to you.
Yeah, thanks, Grady, and really appreciate being here today on this panel. As Grady said, I'm really excited for this because I grew up in Middleton, went to Middleton High School. I didn't wear my Rogers jersey today. I thought that might be a little bit too much, but I'm based in Minneapolis. 3x5 is a growth-oriented venture firm with a nationwide focus. Offices in Portland and Minneapolis. So by having offices in both the West Coast and the Midwest, we have a really good periphery to cover a lot of different innovation hubs, including through the Midwest, East Coast, and West Coast. Really what our goal is to solve some of the biggest challenges facing our planet in both healthcare and in the climates, from a standpoint of the various healthcare and environmental challenges that we face, as a planet, And so what do we mean by invest in what the world needs? It's biotech, medtech, diagnostics, and the climate solutions, energy, water, waste, agriculture. We typically are the largest investor, typically 6 to 8 companies per fund. We kind of, we consider ourselves patient capital, often investing in Series A and B. And we partnered with groups like Roche Ventures, Breakthrough Energy, Rivervest, and I'm one of 4 managing directors. And, super excited to be, chatting with everyone today about these topics.
Perfect. Thanks, Joe. Evan.
Sure. Thanks, Grady, and thanks to you and Carrie for hosting this panel. Excited to be involved. Plymouth Growth is a growth stage venture capital firm in Ann Arbor, Michigan, which is where we're based. It's where I grew up and came back to as I was raising my family. So we are investing in the growth stage. So a few stages later than where Victor was talking about, but a similar type of technology focus, typically revenue profiles in a couple $1 million on the low end, up to $5 to $8 million, typically larger rounds, larger post-money type valuations, and really finding businesses that are kind of going from point A to point B. We're taking companies from a couple $1 million of revenue to 10, 15, 20, and then executing on a strategy of exiting those companies and oftentimes having other firms, larger private equity firms, for instance, take over from there. We're investing out of our 4th fund today. We have a few slots left in that fund, 8 to 10 slots per fund, and we're going to be out raising Fund 5 here over the next couple of months.
Perfect. Thank you, Evan. And then last but certainly not least, Natty with Matchstick.
Yeah. Well, thanks for having me. I am based in Boulder, but my family's from Wisconsin, and I spent every summer from 0 to 18 in Milwaukee at my grandparents' house on Capitol Drive. So love the state of Wisconsin. Matchstick Ventures is a $30 million seed fund. We focus on software companies that are based in the Rockies with a little bit more of a focus in Colorado, and then the North region with a focus on Wisconsin, Minnesota, and Michigan. We're generalist investors at the earliest stages. So similar to Victor, we're looking for companies that are trying to change a market through the use of software or innovate in a space using software. We typically invest $500K into our companies at that seed or pre-seed stage, ideally buying anywhere between 6 to 10% of the company. And typically the companies we invest in are sub $1 million in revenue. We try to bring a network-based approach to investing, which means that we surround the companies that we invest in with a network of leaders and other startup executives who have been there and done that to help those companies scale. We learned a lot of this by running accelerator programs through Techstars, which also has a network-based approach to helping companies scale. And then I think another area we focus on is a lot around how do we help the leaders in our organizations develop personally and pursue personal growth as a means to professional achievement, because we believe that the better the CEOs or the leaders can be and understand themselves, the better leaders they're going to be for their company. We love the markets we invest in, the Rockies, the Midwest, the North regions, not only because we live there and we're passionate about it for the lifestyle that it affords, but we think it's one of the biggest opportunities in venture right now to invest in these underserved geographies where there's still a ton of innovation happening.
Well, thanks, Natty, and thanks, guys, for that intro under your firms. And obviously, people on the calls, please go check out their websites, and we'll connect you guys to these guys after the call. But a lot of topics I want to cover today, and you guys addressed or actually brought up quite a few in your intros here, but deal flow and what you guys are seeing specifically as it relates to the startups you're looking at here and throughout the Midwest. Victor, I want to start with you, and given M25 and your strategy has invested solely throughout the Midwest, and it's been incredibly active in recent years, and just given the large number of startup companies, you've been able to really put the Midwest on a map from a numbers perspective. Talk to us about your deal flow and why you're seeing so much quality here throughout the Midwest.
Yeah, thanks, Grady. So, when it comes to, the deals that we're seeing, and deal flow is a term just more generally of the opportunities that we are both sourcing outbound and also coming to us. The amount of deal flow has significantly increased. Now makes up, if you look at just deals that happen from an early stage venture perspective across the U.S. landscape, we're now over 10% of all U.S. venture deals are in this kind of 12-state, Midwest census definition. So that's up from 5% maybe about 10 years ago. So if you think about that, that's a relative number. So we're relatively gaining on the rest of the U.S., and the whole U.S. has risen in startup activity. So the number is more than just twice what it was 10 years ago. It's significantly higher. This year, we've sourced 816 deals across the Midwest. We actually have been seeing a huge spike in Q3. I think there was a little bit of a lull, obviously, with coronavirus in Q2. And the opportunities are pretty varied. The Midwest has the most diverse economy across all the different regions. We have seen, obviously, a lot of B2B software, whether it's for SMBs or enterprise. You look at the U.S. actually has, or the Midwest actually has the most Fortune 500s than any other region in the U.S. And then also we see a lot in some key industries that the U.S. is, or the Midwest is very large in, such as insurance, healthcare, transportation, logistics, even manufacturing, or some of the more physical production with that can touch supply chain as well. Obviously, a lot of property tech or real estate tech, and even things that we aren't necessarily known for explicitly, but are just large aspects here. So gov tech, ed tech. We've even seen invested in a decent number of consumer companies. So e-commerce, CPG, or things that are enabling that type of a commerce to happen. And also, financial technologies too, outside of insurance as well. So it's very varied, and that doesn't even touch the life sciences, which obviously Joe is more situated in. But the diversity of the types of companies we're seeing is really significant. I think sometimes people kind of try to pigeonhole one state or our region as a whole as in a few different industries, but our portfolio itself and then just the region as a whole has had success in a lot of different types of industries. And we've had unicorn exits across the region in healthcare, cybersecurity, B2B, consumer. We've seen quite a bit of diversity there. So that's exciting about what we're seeing.
Natty, you guys look very early on. You guys are covering from Colorado all the way through Victor's territory here in the Midwest, but it's still a pretty untapped landscape from here to you guys. Anything to add to what Victor said, echo what he said, or anything different?
I always look to Victor for my Midwest stats and data. So, hard to add much to what he said. I want to add one other trend that we're seeing that we really like, which is all of these Fortune 500, 5,000 companies are going through digital transformation faster than ever. And I'm sure a lot of the folks on this call are feeling that in their organization. And what we have a unique opportunity in the Midwest to do is to lead on that digital transformation because we have so many of these organizations in our market. And we're seeing a lot of interest from startups to be in the market because these Fortune 500 or 5,000 companies are here and they're potential customers, they can innovate with them. And so I think that that's a big tailwind that we have in this market is people want to be near their customers, and a lot of our customers are here. And we've seen in our portfolio, a lot of our best performing companies are entrepreneurs who spun out of the corporates in this market and realized a problem internally at their corporate and realized, I'm going to go solve this, and are doing really well. So that's one of the trends that I'm really excited about in this market. And especially for the folks on this call, I think the more we can connect the corporates with the startup ecosystem, the better we can all do in that digital transformation and bring all of that innovation into our market and into our companies.
Joe, Natty and Victor are looking very early on, in early stage, and Natty will definitely circle back to the corporate involvement, and I'm glad you brought it up. But Joe, larger check sizes, similar to kind of what Evan is looking at the growth stage almost, but specific to life science and natural resources, can you share with us a bit more why 3x5, a Portland-based as well as Minneapolis, why does the venture fund want to have a more prominent presence in the Midwest? You guys must be finding good deals, good teams.
Yeah, no, and I so echo what Natty and Victor were saying, especially on we have so much to offer here in the Midwest and the West Coast. A a really good friend of mine, a life science investor, literally decided 2 weeks ago they're opening an office in Boulder. And the reason for that is the cost of living. I mean, entrepreneurs can't even start companies. They can't afford to start a company in the Bay Area at $1,000 a square foot. So we're seeing this kind of exodus and migration of talent that is, even starting at venture funds. And so, but in terms of deal flow, actually, throw out some more stats, 82% of our portfolio is outside of Silicon Valley. And, why is that? Because we're looking for passionate entrepreneurs regardless of their location, and so when we looked at our Salesforce data, 13% of our deal flow since the early 2019 was from the Midwest. And that may not seem like a lot, but that compares to about 22% for the West Coast and 22% for the Northeast. So we have a pretty, kind of agnostic approach to how we look for deals. And, also some interesting data to share. Since early 2019, I got this information from a contact of mine at SVB, Silicon Valley Bank, for those that may not know, which is a great, venture debt group. 1.9 billion raised in the Midwest and 114 life science companies. So that's diagnostics, biotech, and medtech. But 70% of those went to companies located in Minnesota, Ohio, and Illinois. And so, when I look at, specifically Wisconsin, which is near and dear to my heart, I think there is such an opportunity for the state to play such a big role going forward. And I was on the phone last week with a serial entrepreneur in the life science space, and, it's a commercial stage company. And so when you look at, kind of to close up on this, from my perspective, universities, significant number of corporations, the stage is set for Wisconsin and the Midwest. I think it's just about creating those connections from the coast and drawing interest as much as possible, and that's obviously what we're talking about today. So.
Right, and Joe, we'll circle back to almost some of those misconceptions as well, because I do want your take on that. Evan, similar question, but I want to lump in the idea because you and your team are pretty good at assessing talent. I mean, you guys are at the growth stage, the founding teams might be set, but I do want, just for our listeners here, define what the growth stage is for you guys in terms of deal flow, because it is different than what we'd see on the coast. And then also talk about a little bit the Midwest entrepreneurial talent that exists and how you guys scale that deal flow with what exists here.
Yeah, I want to circle back also to Victor and Natty's points. The reality is the deal flow has improved for growth stage funds because there's great early stage funds out there. There's so much more early stage capital focused on entrepreneurs in the Midwest. And a lot of our deal flow comes from folks on this call and similar funds that are putting early dollars into companies, helping those companies along, and then getting to the point where they can go confidently raise $5 to $15 million for that next round. And so a lot of credit is due to the early stage funds in the Midwest. And then a lot of credit is due to the talent that not only exists, but Joe mentioned some migration from the coast, which is happening, and it was happening pre-COVID. Some of the trends that are happening with COVID, I think, are just kind of speeding up the process that was already in place. What we've seen in terms of talent has been so much better, even in the last couple of years, than when I first started investing in the Midwest. I think that goes to not only lifestyle choices that people make and cost choices around where's the best place in the country or the world for that matter to go start a business. It's also that remote work is becoming more and more realistic, and more companies are open to that, again, even more so now than even a year ago. I'll give a great example. We invested in a company that Victor and M25 invested in a few years ago in Cleveland. Great business. Had, for the most part, always been based in Cleveland, wanted most folks to be based in Cleveland historically. They've made the most recent 3 hires they made, which are unbelievable talent across sales and business development, engineering, and marketing. All 3 of those people, none of them have relocated to Cleveland. One's in the Northeast, one's in Michigan, and one's in Chicago. We could not have gotten the kind of talent that I think that they needed by just looking at Cleveland alone. So not only are more companies able to do that, but more and more great talent is realizing they don't have to be in New York. They don't have to be in Silicon Valley to start and build and grow great businesses. So I think the talent has only gotten better since I've been here, and the case for building a business in the Midwest is better than it's ever been.
And Victor, you posted recently about, on Midwest startups on your blog, and for those that haven't seen it, go to midweststartups.com. It's got a lot of data and research on there. But what's your take on this talent? I mean, you guys see 800 teams, right? There's entrepreneurs here.
So, there's a lot of really interesting data points there. I think that one of the things to think about is that the Midwest actually has a huge amount of talent, but sometimes we're a little more spread out. We have about 13 ecosystems, over 1 million people, and that does diffuse some of it, but connecting it through a lot of different methods, especially venture capitalists are a great way that companies can connect with each other and access to new networks. Also, corporate connections, NVNG, those type of relationships also help. So the Midwest has the second highest number of computer science grads after the West Coast. They're 26% of all U.S. Computer science graduates are coming from the Midwest, from Midwest universities, and it's 32% from the West Coast. So that's the second highest. So that's a great source of talent coming up from the bottom. Additionally, the Midwest has a huge advantage in cost of living, and that directly translates in the cost that it takes to attract and pay for quality talent. I actually had some interesting stats on specifically looking at the developers, so kind of the builders of software companies, right? And we saw a over $25,000 difference from Boston to Milwaukee in what it costs to pay a tech developer. So in Boston, they're paying them $118K a year. In Milwaukee, they're paying them $93K a year. But the adjusted salary, when you adjust it for inflation, is much smaller. It's only a $7,000 difference. And actually, Milwaukee, among 5 other Midwest cities, is 5 of the highest adjusted tech salaries when you account for the cost of living. So you can actually have a really good quality of life living here and not pay nearly as much. So it's kind of the perfect match between what a company would have to pay, what a startup or a larger scaling company would have to pay, and also what an employee, the benefit is. So I thought that was a pretty interesting thing. Lastly, there's also a huge element of employee loyalty here. So people are, and that's some other data I looked into. The Midwest has huge employee loyalty, actually led by Milwaukee. Out of all of the cities in the Midwest, had the highest employee loyalty for tech developers, was what I was looking at, kind of more situated into our industry. But we had also a huge amount of founders that, upon exit or upon either the failure or success of their startup, Madison and Milwaukee were 2 of the highest percentage of founders staying in the city to either take up a new job or maybe start a new company. So I thought all those stats were pretty interesting and kind of really are good signals for if you're going to invest or hire people, in the tech world in the Midwest, it's seems to bode really well. We're kind of leading in that in the Midwest. So.
Which is, obviously awesome to hear. And Victor, thank you for putting that blog out too, by the way. I think it's helpful for the guys on the call and for me too. But so the entrepreneurial density, the talent exists here. Like Evan said, you can pull it from elsewhere as well because people want to come to the Midwest. Natty, I want to shift gears here a little bit and move toward how you had mentioned the co-investor networks. You and your partner Ryan up in Minnesota, you guys both ran 2 of the largest Techstars accelerator programs out there, and you did it for a while. So it makes complete sense that you would turn those into the matchstick funds, be able to harvest startup companies, be able to take that education and teach them. But you talk about these connected networks. Talk to us more about that. Like I said, the entrepreneurs are there, they're forming good teams, but the right later stage investors are also very important. So when you and Victor let them go, those co-investor networks are hugely important. So talk about your strategy there on those networks you mentioned.
Yeah. Well, I'll say, when we think about a network-based approach to investing in early stage startups, there's a lot of parties or stakeholders that are really important in that. And so, the one that you're highlighting there are co-investors. And we look at our job, I'm sure Victor would say the same thing, is our job is not only to help these companies figure out their customer, the product, the go-to-market. It's also to figure out, okay, now that we have a product that's really selling well in market, let's bring in more capital to help this scale. And so we need to be really good at building those relationships. Ideally, we'd keep those relationships in our markets with other folks who are on this call. The reality is there's not enough local capital to fund all of the good opportunities that are coming out of the seed stage. And so more often than not, we are going to the coast for that later stage capital. And we look at our job as a huge piece of that is building the reputation of these markets, highlighting the companies that are here, highlighting a lot of the stuff that Victor said around the cost of living differences, the leverage that investors can get on their capital, the quality of the entrepreneur, the mindset, kind of that, Midwestern, hardworking mindset, communicate that to the coastal funds and get them excited and bring them deals. And actually, it's become a pretty nice symbiotic relationship where they look to us as the on-the-ground investors who are finding and supporting the companies at the earliest stages. And then we bring them the best performing companies or the most innovative companies, and they take it from there. And I think that will be the future of investing in these markets. I think we'll have a set of, ideally, a bunch of good local later stage capital, and then augment that with coastal funds. And both of those parties will look at seed funds like Victor and mine to do a lot of that boots on the ground work and bubble up the stuff that's really interesting. So yeah, other co-investors are a really important stakeholder for us to make these markets successful from an innovation economy perspective, as are the corporates. So, I think you mentioned this a little bit in the question as well. At Techstars, which for those of you on the call that maybe don't know, Techstars is a global network of accelerators that helps companies at the earliest stages do more in a condensed period of time by matching them with great mentors. And Techstars has run, I think we're currently running 7 or 8 accelerators in the Midwest right now, heavy concentration in Indianapolis, in the Twin Cities region. And we do those mostly in partnership with major corporates. So we have one with United Health Group in Minneapolis. We have one with Target, one with Cargill and Ecolab. We had 10 auto companies put together a consortium to do one around the future of mobility in Detroit. And it's been amazing to see those relationships with the corporates, because the corporate partners know that innovation is happening. They know that startups are popping up everywhere in their market, and they don't really have a good lens around what's happening, how can they be a part of that innovation early on. And so it was really nice to see them get involved on the Techstars side. And then from our fund, a lot of the people who are involved in Techstars then also invested in our fund because they knew that we were continuing to grow those innovation products through the fund, and they got a bird's eye view or a chance to look around the corner at what was happening in their markets. And so, and then we also were able to help the companies because we had those relationships with the corporates, and we could help them get customer relationships. We could help the corporates solve some of their problems internally through working with startups. And we think that that's a really important piece of a network-based approach to investing that the Midwest is particularly well positioned to do well at.
Yeah, and well, Victor, for our later stage guys here, Evan and Joe, it's nice to, like I said, have early stage funds here, but I know that you've held events, you hold summits. It's something that I've found very cool, just the development over the last couple of years and attending those summits. But talk to us about your co-investor networks, because I know you do a lot to draw them in. Because I think Natty's right. There aren't, Evan and Joe, we need more of them for sure, but bringing them in, how do you guys do that?
Yeah, Natty is spot on with the need for us as early stage investors to facilitate the co-investment networks and to augment the great local partners that we've co-invested with also some of the national investors that are just, sometimes that's where about 75% of venture capital's head is based, is on the coast. So what we've done is we have really intentionally facilitated twice annual summits that we involve a lot of our co-investor partners, both locally, regionally, and on the coast. And they come, so we attract 150. This upcoming one will have several hundred. But the event is all about matchmaking our portfolio with co-investors that are interested and they've opted in to take those meetings. And it has directly had the impact of we've sourced people that have led seed rounds into our companies, and we've sourced people that have led Series B rounds. So kind of like on a little bit later stage as well as like pretty early stage, we've seen the whole gamut of opportunities of sourcing capital from across the nation into our companies. I think one really interesting example too, which was outside of the summit, we make a lot of connections just throughout the year, is actually an early Matchstick Ventures portfolio company called UPSI, based in Minnesota, that also went through a Techstars program that Ryan, the other partner at Matchstick, had been facilitating that program, had been leading that program. We then had invested as part of the round coming out of that program, as we would call it an early seed round. And through actually my relationship with Grady and Carrie, before they were at before NVNG, when they were at Wharf, they had connected me with one of their West Coast portfolio funds, so True Ventures. And True Ventures had intentionally been looking at investments across the Midwest. They had made investments in Wisconsin before, and also had a really big success here. They were early investors in Duo Security in Ann Arbor, which sold for $2.3 billion in 2018. So they had been very aware of the opportunity to invest in the Midwest, but they had a sourcing issue too. So we created a relationship and started sharing opportunities. And actually, shortly after, I think it was 4 or 5 months after Grady had made that introduction to True Ventures, we had introduced them to UPSI, and they got a $5 million late seed or early Series A round, whatever you want to call it, round from True Ventures. And so we were very excited about that. And that kind of shows some of that teamwork amongst all the different players between the seed funds, between Techstars and accelerators, and also even the LP base, helping to play a little bit of that connector role as well, because that deal wouldn't have happened with kind of all three of us having different touch points. So that's kind of a great example. Who knows, maybe Evan will do the Series B. So
well, kind of taking us through, that's helpful, Victor, and obviously we're here to help connect, so that's great to hear. But Joe, kind of taking us through the full company life cycle here, Natty and Victor at the early stages, you at the later stages. What we've all read about, we all read the same news. Companies are staying private longer, and we've seen this wave proliferate faster and even more recent years. But given our territory here in the Midwest, and we are short on these very, very large rounds, what does it do for early stage companies here, or even the companies that you guys at 3x5 are looking for? What is it going to do, and what is it going to look like? And are coastal funds going to become more diligently, should I say, mobile and look inward as groups like Matchstick and M25 and even Evan's group start to invest when they do?
Yeah, I think that's going to be the case. And I think there's a variety of factors that are going to drive that. First being, which we've talked about today, is just people. People's everything. We got to remember, people start companies, ideas don't. And people are the ones that take the risk. And so that's the most important component out of all of this. And what's very important to 3x5 is those relationships with the CEOs, with the other investors, because there's going to, CEOs remember how you act in the valleys. They don't remember when, how you act in the peaks when you're all high-fiving. And so those key relationships is probably the, kind of the most important thing. And those are, I think groups from the coast are learning that in order to have deal flow in the Midwest, they have to establish those relationships. The second factor is technology. We've talked about that. I think there's been a lot of things that have been accelerated because of COVID. And, I think there's going to be more teams that are built that, while culture is critical, in order to build an A team, you got to realize you don't always have to be in Silicon Valley. You can be anywhere. And then the third factor is competition. Competition in Silicon Valley and Boston is fierce, and more VC dollars have been raised in this country than ever before in the last 5 years. And so there's all these funds chasing these deals in these hubs. And so, great friend of mine who's moving to Boulder, starting an office there for a leading life science fund. The reason he's doing that is he's going to partner with the University of Colorado. There's been a ton of biotechnology that's come out of there. And he doesn't really want to pay $1,000 a square foot for his house. So, there's a lot of things that are driving, I think, and then you see Steve Case's Rise for the Rest, fund. And obviously there was a lot of press on that, but I think it's very true what he's focused on. I think, Victor, you said 75% of all venture capital comes from 3 states right now. And luckily the numbers for the Midwest are growing. But where are those later stage dollars? Where are they going to go? They're going to go to places that have vibrant venture communities. And you're seeing it in Chicago with Google going there. You know, and especially to attract places for entrepreneurs. I mean, the University of Wisconsin, so many people come to the university from all over the country, but they're leaving to go to opportunities, you know, on the coast. I think that's going to change dramatically in the next 20 years. So, and then the last thing I would say is just, if you ask most of our CEOs, what's the most important thing to their success? It's people and the ability to recruit talent. And that's the case for early stage, late stage, public companies. And so fostering that with, you know, various, you know, not only the connections we're talking about here, but remembering like it's the people that are going to, you know, drive the success of, you know, these local economies. It's not necessarily the VC funds. We're part of that, but it's the people that, you know, we got to remember. So.
Right. You know, Evan, I read recently that Midwestern states have actually had a similar total number in startup deals when you compare to these coastal epicenters. The obvious difference being the dollar values were almost 5 to 12 times higher, right? But for those larger company exits that are achieved on the coast, do you agree with what Joe is saying here, and these epicenters are going to grow and become that, or when are we going to see these massive later stage rounds happen here?
Yeah, I think, you know, you talk about this funding gap. I think it exists, right? Let's not pretend that the Midwest has the same amount of capital or the same amount of funds or the same amount of dollars going to these deals. It's a different market. The gap is shrinking for sure. But you also got to create great companies with great people, and dollars find opportunities. I don't think there's actually a gap for great companies. If you've built a great company with a great team who deserves to go raise 10, 15, 25 million dollars, good funds will find those companies, and good funds have found those companies. There've been more large rounds and more large exits in the Midwest over the last couple of years than ever. I think that, to me, the gap is more where we play, which is it is hard to raise raising $1 million from active angel groups and active early stage investors. Not that complicated if you have a good track record and a good group of folks. Raising 5 is a weird check size. The coastal guys typically will not fly to Cleveland or Madison or Milwaukee for that small of a check. They just have too much capital to deploy. So you need to create an opportunity where you can get from that $1 million to that $5 million, and still, you know, these guys have talked about the network being really important. It's really important to us too, because if companies are going to go raise 20 or more, those are going to be coastal funds, and you have to have those connections, but you also have to have a team and an opportunity that's proven they can deploy 1 and they can deploy 5 well and hit those milestones to deserve that funding. And once they do deserve it, there's a ton of capital to come into a Milwaukee and raise a $20 million round. But you kind of have to have those proof points and have those milestones along the way. It's not, people don't write checks kind of randomly based on an idea, right? They write checks based on hitting milestones and having a great team with a great track record.
Right. So, I mean, and kind of just, again, transitioning here, but given our topic does revolve around this more or less decentralization from the coast toward peripheral markets or all of our Midwestern markets that we cover, Joe, I want to address, you know, the elephant in the room here. There's a lot of misconceptions around the Midwest. You guys have highlighted a lot of them here. Any more that you would add? I mean, because again, the sentiment around the Midwest is we're transforming and rebranding the Rust Belt. VC-backed companies are supposed to be, you know, usually on the cutting edge of emerging sectors and technologies and not old industry or old economy. But the Midwest has that, and it has both. What other misconceptions do you have to teach your investors, or maybe, you know, your coastal co-investors that talk about the Midwest?
Yeah, I think it's a balance between the perception not being the reality. And I think for funds that really strive to, you know, do the work and fly, or in the midst of COVID, get on a Zoom call to partner with entrepreneurs and get to know them. I think, you know, as Evan said, the capital is there. It's just kind of moving past that, you know, getting on the phone and taking the time. For example, we just backed an immunotherapy company that's originally was spun out of WashU in St. Louis. We've also backed a commercial stage company in St. Louis in the next gen protein detection, biomarker analysis. And so I think probably the biggest misconception though is the talent is not here, and that you have to build a company on the coast to get the right people. And so we talked about all this, so I'm not going to repeat it, but I do think, based on that statistic that put forth, that there are some places in the Midwest that are further along than others, just based on the data, at least in the life science. It's funny, a lot of people don't remember that Medtronic was started in a garage in 1949 by Earl Bakken. And now it's the biggest, Minneapolis is known as a med tech hub, but the only reason that is the case is because Medtronic was started here. So, it doesn't mean, that it's, there's a lot of misconceptions there. And then I do think, and obviously that's a part of what NVNG is doing and what some of these other markets have done well, is that the connections to corporations are critical. My partners and I, we just got off the phone with Exelon in Chicago to talk about some of their next gen energy projects. And we've agreed, they're excited about knowing what we're working on. And the same thing with Medtronic. I've been on numerous calls in my career with the Medtronic business development team. And so I think corporations have a big role to play because, quite frankly, they also have the most to lose if there's disruptive technologies out there. And so we can offer to be the eyes and ears on that early innovation. And so I think, kind of getting to your point about what are the misconceptions, I think it's the talent that's not here. And I also think that getting VC firms that maybe typically wouldn't focus on the Midwest to forge partnerships with those innovation leaders, both on the corporate side and LPs, I think that's part of the equation to get more firms to kind of spend time here.
Victor, I think one of the things that Joe's talking about here, and is the ability to get firms here, but one of the largest misconceptions, and we talk to a good amount of limited partners that are on the coast that only invest where they know, but we're a limited partner who wants to impact place as well, but we're also a financial investor. I mean, there are returns here in the Midwest. One of the biggest misconceptions that I hear is the returns aren't here. So can you talk to us a little bit about that and maybe this path to future unicorns that everybody is after?
Yeah, it's actually the opposite is true. First I'll walk you through just a quick bit of logic. Basically what we're seeing is these companies they have less access to capital early on. And they also have less need for capital because their expenses are lower, rent, cost of employees, etc. They are able to get by with less. So that also means less access and less need means that the valuations are lower. So what's happening is the average valuation in a place like Wisconsin is sometimes 50% or less than that in Silicon Valley or New York. That being said, when the company grows up and gets bigger, they sell to a buyer that's on a national or a global level. And so the exits, those prices are being bid on from everybody. They're not just the local group, and the returns are still unicorn, billion-dollar plus company status. And we have, dozens of unicorns now across the Midwest landscape, and a lot of example exits, in not just in one hub, not just Chicago, but in a lot of different cities, Ann Arbor, Columbus, Indianapolis, the list goes on. So that's probably just the most interesting from a logic perspective. If you look at the actual metrics, the Kauffman Foundation found that if you invested $1 million in equity in a company, the average company in the Midwest, you would own 2.4 times as much as if you invested in a Northeast or Pacific based company. So you're buying a lot more for your $1 million. And then when you look at it, the exits, as I said, just still the same level. So they look at it by region. This was a Crunchbase analysis, but the Midwest has the highest MOIC, multiple on invested capital, at a 5.17x multiple, compared to the Northeast at 3.89x, or the West at 4.29. Okay, so that's pretty significant difference. And they looked at some cities, and Chicago was the only Midwest city that came up, but it was the highest as well, a 5.6x compared to the Bay Area of 4.2. So that's probably the most, damning evidence that our returns are going to be better actually than, and it's not because that necessarily the exits are different at all. It's that we're getting in and to more capital efficient, earlier, capital efficient at lower valuations. And so they don't get diluted as much, and you don't get as the price that you buy is a lot lower. So I think those are the two kind of biggest aspects here.
And Natty, kind of how Victor is going into almost what the macro environment looks like in the opportunity set here, because not only are the returns currently here, I think they will be as well, like he's saying, but to address kind of what the macro environment looks like, COVID, the future of work, what does this next wave of founders need to really succeed in this near future where they're still living in land of uncertainty? How are you helping with the portfolio companies deal with those COVID restrictions? And again, just a lot that's unknown here. How are you preparing the portfolios for this?
Yeah, I think that the best founders find a way. I think like we would all share the similar pattern recognition that, if you back the right people, they started the company for a reason. There has to be that underlying obsession for them around solving this problem and serving this customer. And they know by getting into it that, it's not going to be a linear path to their goal. And I think, none of us have had to deal with a global pandemic on the pursuit of that journey of a business success. But, the best entrepreneurs that we've worked with have been very smart about handling it. We've worked with all of us have worked with our portfolios to make sure that they're making smart decisions around conserving capital, pivoting the product if need be, in case their market is slowing down their purchasing due to, them being in financial uncertainty. But, the best companies and the best founders are riding it out pretty well, I would say. But I do think our job as investors is to share those insights and those patterns that we're seeing across working with lots of different companies with the ones that we're involved in. And that's what our founders do look to us for. So, speaking on the matchstick side of things, we actually in late February started preparing companies to say, if the market slowed down, how might that impact your runway? How might that impact your need for capital? Do you want to adjust your hiring plans? Do you want to adjust your spend plans to make sure that you have your capital for longer? And I will say, all of our companies were incredibly responsive to that. Many of them had been taking those steps ahead of time. And then I would say on the flip side of it, we've been shocked at how fast the markets have come back for our companies. I mean, we expected a longer downturn than we've seen, but technology has obviously been more important than ever. From our lens and in our world, software is, more critical than ever. And so the buying cycles of our company's customers have not slowed down nearly as much as we thought, because companies need to adopt technology more than ever now. And so, it's been surprising how fast stuff has come back. And I don't know, maybe tying it back more to the Midwest mindset, I think that a lot of those conversations with our founders around making those tough decisions early were well received by the Midwest mentality of, willing to do the hard work and be upfront around it, where, maybe some of the founders in other markets, would just sort of rely on, hey, there's always capital available for me. I don't need to make these tough decisions now. Our founders just did it incredibly well. And so I think in terms of what founders need, to succeed in this market, is they need to just keep up that resiliency. They need to keep solving real customer problems. I don't see a real shortage of capital for companies that are doing well. So founders just need to put their heads down. They need to keep growing their business and just be smart about their spend. So, yeah.
Well, and to your point too, Natty, I think that Midwest mentality among founders is really helpful. I mean, a lot of them come from different backgrounds, or maybe they spent time in Silicon Valley and they moved back. But, kind of round robin here in our last 5 minutes on the future of VC here in the Midwest. Victor, let's start with you. What makes you most excited about Midwest VC? What does the next 5 to 10 years look like for you?
Look, we're just getting started with a flywheel effect across all of these cities in the Midwest. When you have a large financing round, or even better, a large exit, a unicorn type exit in one of these cities, it really starts to spin, where you have founders that are pouring out of that, new founders. You have experienced people that have seen what a high growth venture-backed startup can look like. And you have wealth that has been created so that the angel investment community and the venture funds in that community are more active. We've seen examples, and I think, you know, you look at some cities like Indianapolis being a prime example, where the exact target exit in 2012, I believe, has then created new funds, has created a host of new investors, and has created a lot of people with really strong exact target or Salesforce, the acquiring company experience, that have gone on to start new companies, and even created a little bit of a niche for Indianapolis in marketing tech. So we're seeing that now happening in more and more communities, and it's very exciting to watch, because, you know, these are more backable companies than we've ever seen. These are maybe faster growth. They're going to skip some of the mistakes of the past, and so that's what I'm excited about probably the most out of anything.
Joe, because he mentions these, because it is interesting. You look at Indianapolis, like Victor said, a lot of marketing tech is coming out of there. What about life sciences? I mean, we obviously know where the life science hubs are on the coast, but what about in the Midwest? Are we going to see big life science hubs here really proliferate? And are we going to see natural resources and energy hubs here that'll be good deal engines for you guys in the future?
Yeah, I mean, I think a lot of it is driven by, again, I keep going back to the people and the people that are taking the risk. I think more and more people, I think, are going to be, you know, whether it's people coming out of corporations that are in the Midwest that are already here, and which there's more Fortune 500. I don't know the statistics. Victor, you seem like you should go on Jeopardy. I've never seen so many awesome stats. So you probably know this one, but the amount of Fortune 500 companies in the Midwest is just incredible, in the diversity that it brings in terms of the different sectors. So, you know, as I mentioned before, you know, we're always on the phone with different corporations and, you know, looking through that lens. So absolutely, I think it's a combination of universities. I think it's, you know, corporations play a role. And then just our focus, I think from 3x5's perspective, with over 80% of our portfolio outside of Silicon Valley, we're seeking out those relationships, not only with other VC partners that are, you know, like Natty mentioned earlier, that are maybe a little bit more early than us, that, you know, we forge those great relationships with, but also just trying to find, you know, just people that are, you know, that want to take the risk, that need a partner and have great ideas. And there's a lot of them out there. I think it's, that's what's exciting, is there's, the stage is set, I guess is what I'd close with. I think we need to just fuel it with different avenues to do so.
Perfect. Evan, agree real briefly here while we have time?
Yeah, absolutely. And just wrapping a couple of different pieces that folks have talked about. It is a market where CEOs and founders do a lot with a little. It's a really gritty set of people who are hardworking, have Midwest values, and realize that you don't need to raise hundreds of millions of dollars to build a great technology business. You just don't. So the opportunity for someone like Plymouth and for other folks on the phone and for other folks who are listening in, the ability to get in early to a company that's raising a round that's not going to get the attention yet of coastal venture, getting in with terms, valuations, and with teams that you want to back, getting all that set up early into a company that's not going to raise these massive rounds, or doesn't necessarily need to. You don't take the dilution associated with that, but when you do sell or raise follow-on capital, you are dealing with national firms and national multiples. So the natural arbitrage between investing in the Midwest and exiting into the national landscape is really interesting. And unicorns are great, and we're going to have a bunch of them, but we're also going to have dozens and dozens and dozens more exits in the $50 million range to $500 million. And for those entrepreneurs that haven't raised a ton of money to get there, that's a life-changing event and can still breed the same success and the same folks that we've been talking about in terms of these unicorn exits.
Natty, real quick, while we have anything that you want to add to what these guys share about what makes you excited about the Midwest?
Yeah, the only thing I would emphasize is I think that one thing we can do is marry the relationship between corporates and startups way better than anywhere else. Like, I think in most parts of the country, there's sort of a animosity between the two. Like, the corporates are afraid of startups or don't believe in them. The startups are coming after the corporates. Like, let's rethink that in the Midwest and say, hey, let's partner together. Let's figure out how can we create technological change together? How can we be customers of each other? How can we partner together? Maybe we invest in each other. And I think that that's a unique opportunity that this market has that would be different from what everyone else is pursuing and would make all of us better.
Well, obviously, Natty, at NVNG, we completely agree. And it's kind of core to our mission here. But, well, guys, thanks so much. I do want to wrap here a little over time, but thank you guys for being a part of this. I can speak for our attendees as well, and for Carrie, Linden, and myself at NVNG. Greatly appreciate the time that you guys had, and hopefully we're all able to learn a thing or two about the happenings about the Midwest venture capital scene. For anyone looking to connect with Victor, Joe, Evan, or Natty, do be sure to reach out to us directly. We're happy to connect you guys to them. Obviously very personable people, and they're happy to talk to you. Exciting stuff, guys, happening throughout the Midwest. Thanks so much for sharing. Last note here, do follow us on LinkedIn if we ever want to put more events together. Make sure that you guys stay up to date there. If you're ever interested in hosting an event, or if there's a topic you want us to try and cover, feel free to reach out and let us know at any time. All right, everyone, thank you guys so much. Definitely stay safe, stay healthy, and we'll be in touch.
Thank you. Appreciate it.
Thanks.